Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the money world so you don't have to. Today we are diving deep into a fresh SEC filing from Space Asset Acquisition Corporation. Now this company is a bit different. It's a blank check company looking to merge with another business. And sometimes those filings can be a little dry, but we promise we dug for the juicy bits. Stick around as we decode their plans' risks, and especially those numbers that tell the real story. Alright, so what is the big picture here? Space Asset Acquisition Corporation, or SPAC, is essentially a shell company recently formed. They are planning to raise a pretty significant chunk of change, with this offering about $200 million, initially aiming to find a business to combine, with a lot of this money is going straight into a trust account that is standard practice for these types of companies. They are based in the Cayman Islands, which has some interesting tax implications. We will touch on that later. But primarily this filing is about them laying out their strategy for raising funds and what sort of business they are looking for. The core of this offering involves selling 20 million units at $10 each. Each unit is a package deal. It comes with one Class A ordinary share and 1/3 of a redeemable warrant. So basically a share and a piece of an option to buy more shares later. The underwriters here, BT LLC, are getting a $2 per unit commission, with a chunk of that being deferred. That is $10 million up front and another $11 million potentially being deferred until a business combination happens. Now here is a classic SPAC move. The sponsor, Space Asset Acquisition sponsor, LLC, is ponying up a bit more cash, buying 585,000 private placement units, also at $10 each. This is common practice. It shows commitment from the insiders and gives the company some additional capital. They are also getting founder shares, about 7.6 million of them, for just $25,000. That is a tiny fraction of a cent per S-share, which can lead to significant dilution for public shareholders if you are not careful. The filing explicitly warns about the dilution from these founder shares they acquired for practically nothing. This is a critical point for any potential investor. The sponsor could make a killing even if the company ultimately underperforms for public shareholders. They bought these shares at about 0.3 of a cent each and are selling them as part of the deal as units for $10 each. The filing calculates that if the company is valued at $200 million upon a business combination, then the implied value per S-share for public shareholders could actually be lower than their initial investment after taking into account redemptions and other costs. It is a significant difference between the sponsor's investment and their potential return. So what is their strategy? Space Asset Acquisition Corp is focusing on the global space economy with a particular interest in technology and defense sectors. They believe their management team's extensive network in these industries and in private equity gives them an edge in sourcing and evaluating potential acquisition targets. They cite rapid growth in the space sector and increasing defense spending as key drivers. The founder shares are worth mentioning again. They total 7.6 million initially, but up to 1 million of those could be forfeited if the underwriters do not exercise their over-allotment option. This is a way to manage the sponsor's ownership percentage relative to the total offering size. The founder shares also have some cool conversion and anti-dilution rights that can get complicated, but basically mean the sponsor could end up with more class of shares than initially anticipated under certain conditions, which again points to potential dilution for everyone else. Let's look at the money flow and expenses. The underwriters, BT LLC, are set to receive significant commissions, including a large deferred portion of $7 million or more that is only paid out if a business combination is actually completed. This structure incentivizes the underwriters to help the company find and close a deal. The company estimates its own offering expenses, excluding underwriting commissions, to be around $600,000, covering legal, accounting, and other administrative costs. This dilution point is hammered home multiple times in the filing. They are very upfront that public shareholders will experience immediate dilution due to the sponsor's nominal purchase of founder shares. This is a major risk factor that potential investors absolutely must understand. A critical deadline is the 24-month completion window. If they can't find a business to merge with in that timeframe, they have to give all the money back to public shareholders from the trust account. This makes the ticking clock a very real pressure on the management team, potentially leading them to rush a deal. Then there are the numerous conflicts of interest highlighted. The management team has other commitments and may be involved with other special purpose acquisition companies too. This could mean divided attention and potential conflicts when deciding which business opportunities to pursue. They also have agreements that could allow them to transfer their founder shares and private placement units. Turning to the financials, as of the 30th of September 2025, Space Asset Acquisition Corp had no cash and about $74,000 in deferred offering costs. Their total liabilities were $90,000, primarily accrued expenses and accounts payable. Shareholders' equity was a tiny positive $14,000. This is typical for a SPAC before it goes public. The net loss for the period was about $10,000. The dilution calculation table shows a net tangible book value deficit of over $90,000 before the offering. After the offering, depending on how many shareholders redeem their shares, the adjusted net tangible book value per share could be as low as around $3.71 from an offering price of $10 per share. This is a massive dilution. Even in the best case redemption scenario, the dilution is very high. The sponsor, Space Asset Acquisition Sponsor LLC, is a Delaware limited liability company. Its managers are Peter Ort, Jeff Tudor, and Raphael Roetgen, who control the sponsor. They collectively own the economic rights to most of the founder shares and private placement units. Regarding dividends, the company has no intention of paying any dividends before a business combination. After a business combination, any dividend payments would be at the board's discretion, depending on earnings and financial condition. A significant risk is that third-party claims against the company could reduce the funds in the trust account. This means public shareholders might receive less than the expected $10 per share upon redemption or liquidation. The sponsor has agreed to cover some of these claims, but it is uncertain if they have enough assets to do so. There are also extensive sections on selling restrictions in various countries, including Canada, Australia, and Singapore, detailing the exemptions they are relying on to offer these securities internationally. For Europe, they are selling only to qualified investors, which means essentially large institutions or individuals who can afford to take on the risk. They are careful not to offer these securities to the general public in Europe, which can be quite complex legally. So what is my take on Space Asset Acquisition Corp? Well, it is a SPAC, a company with a very specific purpose: find a business merge and hope for the best. Their focus on the space economy is timely given industry growth. However, the dilution from founder shares is substantial and a major red flag. Investors are essentially betting on the management team's ability to navigate the complex SPAC landscape and find a good deal within that tight 24-month deadline. The risks around not finding a deal and general market volatility are very real. The financial table regarding dilution is stark, showing a potential loss of value for public shareholders. If redemptions are high, they are upfront about that, which is good, but it emphasizes that this is a high-risk, high-reward play. Alright, that is our rundown of Space Asset Acquisition Corporation's SEC filing. What do you think about their space strategy and those massive dilution warnings should they find a unicorn up there? Or is this just another SPAC that might return money to investors? Let me know your thoughts in the comments. If you found this breakdown valuable, give us a thumbs up and subscribe for more corporate decoded content. And hey, join our Discord community linked below to keep the conversation going. Thanks for watching, and we will see you on the next episode of Corporate Decoder.